Good morning, everybody. Welcome to another daily market report brought to you by Mike Bjork. Today is Friday, November 21st. As I mentioned yesterday, no economic news release is scheduled for today, but we will kind of jump into a little bit about the FOMC Minutes, what it's going to mean, and the outlook of interest rates. But first, we'll kind of touch on this here at the headline news. The stock market's up a bit today. The Dow is actually up over 140 basis points, and those are the news. And these news will actually kind of tie into what I'm going to say. China cut their interest rates, which is a good sign to try to help stimulate their economy. And the European Central, the ECB, the European Central Bank, started their own quantitative easing. So they started purchasing their own assets in Europe today to try to stimulate their economy. So as a result, the stock market took off a little bit. As you read the FOMC minutes, the last meeting we had, we ended our quantitative easing. The minutes kind of has a little bit of a hawkish tone, which means basically they're going to do everything to fight inflation. Whereas if you're a dovish tone, it pretty much means that you are worrying more about the economy than you are about inflation. Right now, inflation's at a point where it's very low. It's at 1.5%. But at some point, when everybody else starts going on all cylinders, it will start rising a little bit higher, and we're going to have to start raising rates. My idea, because if you think with those minutes, even though it had a hawkish tone, Janet Yellen has had a history of being more of a dovish type of Fed governor. She has the ultimate vote, so wherever she wants to go, that's where it will go, and most likely that's where it's going to go. If you look at the anticipation is supposed to be middle of next year, 2015, when they will start raising any interest rates. You'll probably hear it more in the spring, the anticipation towards it. But I think you'll see the target date kept around that date. Allow time for the other countries, allow their quantitative easing, their stimulus packages to kind of kick into it, because it takes a good 6 months before those things really start showing any differences in their economies. So as we get to that point, I think you might start seeing interest rates. What does that mean? It doesn't mean our 30-year fix is going to go up. Actually, it could actually help our 30-year fixes, primarily because, if you heard me say it yesterday, the reason why the Fed raises interest rates is to fight off inflation, and inflation is primarily the biggest enemy towards the mortgage-backed securities or bonds, because it erodes the total value of that bond over the course of time. So with that in mind, when they're fighting off inflation, the size of that, there's a little bit more of a rally, and that helps you get a little bit more demand, and that will help our interest rates. Long-term rates. But long-term, we're going to be creeping up. I think we all expect that. Short-term, we may have a few things where maybe there might be a little bit of a correction in there, and it may pull back where the bond market goes up because it's coming out of the stock market going into the bond market, and we'll have a little better rates. But long-term, you're going to see that trend going upwards with those rates. I still think we'll still be in the 4s for a while, 4% range. We probably won't see 5s. I don't know if we'll even see next year, but maybe if we do, it'll probably be late next year, depending upon everything that goes according to plan. But overall, I think you're going to see rates down for a while. They're obviously very cheap, and that's kind of like where I see where things are moving towards with FOMC. So let's take a look at where bonds are today, and we have a nice little spike. We're up at 103.20. We're up about 3 basis points from where we left off yesterday at 103.17. So we're even up from where we left off yesterday morning, which we were at 103.12 yesterday. So trend upwards right now, short term here, is we're going upwards, and that's showing an improvement in the interest rates as we speak. All right, so enjoy the weekend, and we have a nice little improvement in the interest rates today. Next week we have 3 days. Monday there's nothing there, but Wednesday will be jam-packed full of economic data as we head into the holidays. All right, folks, you guys have a wonderful weekend, and we'll catch you next week for the short week next week. Take care. Bye-bye.